Hey everyone, welcome back to another edition of the weekly market watch list, where we break down key insights for traders and investors heading into the week. I'm glad you're here. Before we dive in, make sure you hit that subscribe button so you don't miss a single update. If you find value in these breakdowns, give the video a like and drop a comment below. Let me know which stocks you're watching or any setups you've got your eye on this week. Today's edition is packed with three main things. First, we're covering the key economic events and data releases on the calendar, the stuff that moves the broader market. Second, we're looking at major earnings reports that could create volatility and opportunity. And third, the main event, a hand-picked watch list of 6 names I'm actively tracking this week, with detailed breakdowns on price levels, catalysts, and the setups I'm eyeing. Whether you're swing trading, day trading, or building a long-term portfolio, there's something in here for you. All right, let's get into it. The biggest event this week is the Federal Reserve's decision, dropping Wednesday afternoon at 2 p.m. Eastern. Here's the critical thing. No one is expecting a rate change. The Fed is in a holding pattern. Inflation is still elevated at 2.8% on their preferred gauge, and that's stalling out progress. The unemployment rate ticked up to 4.4%, so there's some softness in the labor market. What traders will really be watching for is any shift in Fed language about future cuts or the economic outlook. Chair Powell's press conference at 2:30 could move markets significantly, so have your charts ready. Before that, Tuesday brings the Consumer Confidence Index at 10 a.m. This measures consumer sentiment heading into the year, and it's a good gauge for whether Main Street feels optimistic or nervous. A beat here supports the bull case for consumer spending. A miss suggests cautious behavior ahead. Also Tuesday, new home sales data and the Case-Shiller Home Price Index, both at 9 a.m. Housing is a bellwether for the economy. Prices and sales trends tell you a lot about credit conditions and household wealth. Wednesday, beyond the FOMC decision, expect durable goods orders at 8:30 a.m. This measures orders for big ticket goods like machinery and equipment. It's forward-looking and can signal manufacturing health. Friday wraps up with personal income and consumption data, which feeds into inflation readings and gives the Fed ammunition for their next meeting. This week is a massive earnings week with over 400 companies reporting. Here are the heavy hitters. Monday, January 27th, Ryanair, RYAAY, the European low-cost carrier, reports before the open. Watch for commentary on fuel costs and 2026 capacity guidance. Tuesday, January 28th, this is the heavyweight day. United Healthcare, UNH, reports before the open. Critical healthcare bellwether on medical cost trends. Texas Instruments, TXN, is a semiconductor play that'll show us demand trends heading into 2026. Boeing, BA, General Motors, GM, and UPS all report Tuesday. These are cyclical, macro-sensitive names. If they beat and guide up, it's a strong signal for the economy. Wednesday, January 29th, ASML and Starbucks report. ASML is the biggest here, the Dutch chip equipment maker. Any weakness in their outlook could tank the semiconductor complex. After close, Microsoft and Meta, 2 of the Magnificent 7. These are AI infrastructure bets. Beats here support the rally, misses trigger a tech sell-off. Thursday, January 30th, MasterCard, MA, Caterpillar, CAT, Visa, V, and Tesla report. MasterCard and Visa are payment processors. Strong earnings here suggest consumer spending is healthy and global transaction volumes are robust. Caterpillar is a massive industrial. Strong earnings equal to confidence in capex and infrastructure spending. Tesla, any miss on delivery guidance or margin concerns in EVs could sell off. Friday, January 31st, we have SoFi, American Express, Apple, Verizon, Chevron, and ExxonMobil. Apple is the crown jewel here. Any iPhone guidance weakness or AI product delays could crater the stock and drag the Nasdaq. American Express is credit sensitive. Strong results support the consumer narrative. Chevron and ExxonMobil are oil and gas plays tied to energy prices. Verizon is telecom. Watch for subscriber trends and 5G monetization. Here's the critical setup. Wednesday, we get the Fed decision. If they sound dovish, growth names rally. Then NVIDIA reports Friday after close. If they crush it, you could see a real push higher in mega cap tech. But if the Fed holds hawkish and earnings disappoint across industrials and consumer names, expect a correction. This week is earnings-driven volatility. Have your watch list positions sized appropriately and your profit-taking levels marked. All right, now let's dive into the 6 stocks on my watch list. We'll start with PayPal. PayPal is still one of the most recognizable names in digital payments, connecting hundreds of millions of consumers and millions of merchants worldwide. It's gone from being treated like a hyper-growth fintech to more of a mature cash flow machine. And that shift is exactly why it's on my watch list. PayPal runs a two-sided payments network built around checkout, PayPal-branded wallets, and Venmo. It earns most of its revenue by taking a small percentage of the total payment volume flowing across its rails. Management has been pushing 3 main levers: buy now, pay later, deeper Venmo monetization, and a new agentic commerce strategy, where AI helps merchants and consumers optimize purchases. On the numbers side, PayPal generates over $6 billion in free cash flow annually, which is one of the biggest points in the bull case. Non-GAAP EPS for 2025 landed in the mid 5 seconds per share, ahead of expectations after aggressive cost cuts and divesting non-core assets at a price around $56 to $57. That puts the stock at roughly 11 times trailing earnings, which is cheap compared with its own history and with many profitable fintech peers. Growth has clearly slowed from the double-digit days, but it's stabilizing. Recent analyses model mid-single-digit revenue growth and operating margins around 19% as higher margin products like BNPL and Venmo become a bigger share of the mix. BNPL volume is growing over 20% per quarter with very high customer satisfaction, and PayPal is pushing that product earlier in the checkout flow to capture more volume. A reasonable base case model projects the stock into the mid-70s over the next couple of years, implying around 30% upside and mid-teens annual returns from today's price if execution stays on track. Upside is before any major multiple expansion, so the risk-reward looks attractive for investors who believe in the turnaround. The bear case is that PayPal has lost its moat. Competition from Apple Pay, card on file, and newer checkout solutions has compressed growth and margins, and the market still views it as a legacy fintech that may never regain its old premium multiple. Management also plans to reinvest more heavily in AI-driven commerce and BNPL to chase growth in 2026, which could pressure margins in the near term. If those investments don't translate into real TPV growth, the stock can easily stay stuck in value trap territory. Technically, PayPal is trading in the mid-50s after a brutal multi-year drawdown from its all-time highs. The 50-day moving average sits above current price while the 200-day is higher still, which tells you we're in a broader down to sideways regime rather than a cleanup trend. Price is hovering just above the 52-week low in the mid-50s, creating a clear support zone where buyers have stepped in recently. On the upside, I'd mark initial resistance around the low 60s where we've seen previous rejection near the 50-day moving average. Beyond that, the mid-70s line up with many fundamental target ranges and prior price congestion. So that's a logical medium-term target if the turnaround narrative gains traction. Volume is lighter than the 50-day average right now, which fits a basing phase more than a momentum move. For me, PayPal is a fundamentals first idea with a value plus catalyst profile. I'm interested in building a position near support in the low to mid 50s with a stop below recent lows, or DCAing slowly as long as free cash flow and EPs continue to trend up. I don't see it as a momentum trade yet. I'd want to see price reclaim the 50-day and start making higher highs before treating it as a swing setup. If the stock breaks down decisively below the 52-week low on heavy volume, that would invalidate my near-term bull thesis when it comes to options trading. I have my eye on two different dates, June 18th, 2026 and January 15th, 2027. At the June mark, the $70, $75, and $80 calls look pretty interesting given the open interest and volume. Compare those strikes with what we see on the chart breakdown here on the screen. The $70 mark seems to be the midway point between current trend lows and the failed trend reversal. Price has essentially consolidated in this range since mid-2022. Now let's look at RBLX. Roblox is an online platform where users create, share, and monetize games and virtual experiences, making it a leverage play on UGC, gaming, and early metaverse trends. The stock has been extremely volatile, but the underlying business is still growing fast. Truthfully, I've made most of my gains on shorting Roblox. I don't like leadership and what the stance they have taken when it comes to protecting minors on their platform, but I'll leave it at that. Roblox makes money primarily through the sale of its virtual currency, Robux, which players use to buy items and experiences built by creators. Bookings, not just GAAP revenue, are the key metric because they capture the value of Robux sold during the period and correlate with both engagement and future revenue. In a recent quarter, revenue grew about 48% year over year to roughly $1.36 billion, while bookings jumped around 70% to nearly $1.92 billion. That's serious top-line momentum. Company also generates strong cash flow. Recent quarters showed operating cash flow up over 120% and free cash flow doubling to more than $400 million. Management expects full-year free cash flow around $1.1 to $1.13 billion, which is impressive for a company that still reports GAAP losses. The catch is profitability. EPS remains negative around minus $1.4 over the trailing 12 months, even though that's an improvement versus prior years. A recent analyst synthesis suggests Roblox might not actually hit GAAP profitability until around 2028, which would require roughly 30+% annual growth in earnings to get there. That's an aggressive path, and if growth slows, the timeline pushes out. So the bull case is all about sustained high growth, a huge creator ecosystem, and eventually leveraging scale into profits. The bear case is that stock-based comp, safety investments, and heavy R&D keep GAAP losses wide, even if free cash flow looks strong. At a price around $74, Roblox has a market cap just above $52 billion and trades at a negative PE, since earnings are still in the red. The valuation is essentially anchored to sales and bookings multiples and long-term growth expectations. That makes it highly sensitive to any shift in guidance or user metrics. Technically, RBLX has already dropped more than 10% early in 2026. after a big multi-year run. The stock trades below its 50-day and 200-day moving averages, which currently sit in the high 80s and low 100 seconds, respectively. That tells you we're in a corrective phase, not a clean uptrend. Current price in the mid-70s sits well above the 52-week low, around 50, but also far below the 52-week high above 150, highlighting just how wide the range is. For levels, I'm watching the high 60s to low 70s as near-term support from recent pullbacks, with resistance in the mid-80s where the 50-day moving average and prior supply zone overlap. For me, Roblox is a high beta growth trade, not a core long-term compounder yet. I'd treat dips into strong support or strong breakouts on heavy volume around earnings as trading opportunities, rather than buy and forget. If the stock loses the 60s decisively and bookings or user metrics soften, I'd step aside and wait for a bigger reset. On the options side, I have some interest on June 18th contracts, 150 strike alongside January 15th contracts, $200 call. Chipotle is one of the strongest brands in fast casual dining, with a long runway for new stores and a proven track record of driving traffic and pricing power. After a strong bounce and a premium valuation, it's a classic quality growth name I keep on the watch list for pullbacks rather than chases. Recently, CMG shares climbed around 16% in a month, clearly outperforming the broader market. That move came as investors refocused on Chipotle's operational execution, throughput improvements, digital mix, and disciplined menu and pricing decisions. Same-store sales and unit growth have stayed healthy, supported by strong brand equity and a loyal customer base. On valuation, Chipotle trades at a forward PE in the low 30s versus an industry average in the mid-20s, and well above many traditional casual dining peers. The market is paying up for a high-quality growth profile with a long expansion runway, even in a tougher macro environment. That premium cuts both ways, great when they execute, painful when they miss. Chipotle does face headwinds from rising labor and food costs. Management has opted to balance value perception with margin protection, not simply pushing through unlimited price hikes. That means near-term margin compression is possible if inflation stays sticky. The long-term bull case is that as they expand store count and maintain strong unit economics, earnings can grow faster than sales over time. The bear case is that at 30+ times earnings, any slowdown in comp growth or cost surprise can trigger a swift derating. From a technical perspective, CMG is trading above its 50-day moving average, signaling short-term bullish momentum. After a correction in 2025, the stock reclaimed key moving averages and has started making higher highs again, with several technical indicators flashing bullish. That said, the volatility profile shows big swings year to year, strong gains in 2024, a sharp drop in 2025, then another rally in 2026. For levels, I'd mark the 50-day moving average and the most recent swing low as near-term support and the prior all-time high zone as resistance and profit-taking territory. Given the valuation, I'm more interested in buying near those support levels than chasing breakouts. Chipotle sits in my quality compounder bucket. For traders, it can be a momentum name when technicals line up, but for investors, the edge is buying fear, not euphoria. I'd look to scale in on pullbacks toward the 50-day or deeper corrections that reset the multiple, with stops below key swing lows. If the stock starts breaking down while margins compress, I'd step away and wait for a better entry. When looking at options, the team is already writing $50 calls with a January 2027 expiration. We've been in these contracts since October of last year. Looking into 2026, We might consider June contracts with $50 and $60 strikes or January $60 and $70 strikes. Sunrun is a leading residential solar and storage provider, giving investors exposure to rooftop solar adoption, financing dynamics, and policy incentives. The stock is highly volatile and leveraged, which makes it a trader stock but still interesting fundamentally. In a recent quarter, Sunrun posted revenue around $725 million, up roughly 35% year over year, and beat EPS expectations with a small profit versus a near break-even consensus. Despite that beat, full-year numbers still show negative net margin and negative PE, reflecting a business that's still dependent on financing and scale to reach sustainable profitability. Debt to equity sits near 3.7%, highlighting the leverage inherent in its model, while liquidity ratios around 1 to 1.5% suggest adequate but not excessive short-term cushion. Analysts generally rate the stock a moderate buy, with average price targets in the high teens to low 20 seconds, implying upside from current levels if growth continues. The main drivers are interest rates, tax incentives, and consumer adoption of solar plus storage packages. Higher rates hurt financing economics, while supportive policy or extensions of credits help demand and capital access. The bull case is that Sunrun continues to scale installations, attach more storage, and eventually convert growth into consistent earnings and cash flow. The bear case is that high leverage, policy changes, or weaker housing consumer demand leave the business structurally challenged. Run has seen wild swings, down over 50% in 2024, up around 80% in 2025, and roughly flat so far in 2026. Technical models show mixed signals, with some momentum indicators positive but several oscillators still flashing sell, resulting in an overall cautious technical stance. Price trades in the mid-teens with support around the low to mid-teens and resistance in the low 20s, where many analyst targets cluster. Moving averages are turning more constructive, but the chart still looks more like a large trading range than a steady uptrend. For me, Run is strictly a high-risk tactical name. If I'm bullish on solar and comfortable with the leverage, I'd size small, buy closer to support, and be quick to take profits toward the top of the range. A breakdown below recent lows or a negative shift in policy or rates would be my cue to step aside. Looking out into the next year, I like June 18th $30 calls and January 15th, 2027 $35 calls for the upside. Stay tuned. We might also short this name when the opportunity arises. Now let's take a look at Oscar Health. OSCR is a tech-enabled health insurer focused on individual and small group plans with a strong digital experience. It's still early in its profitability journey, which makes it an interesting but speculative watchlist name. In its latest reported quarter, Oscar generated about $2.9 billion in revenue, up more than 20% year over year, while posting an EPS loss a bit smaller than analysts expected. Net margin remains negative at roughly minus 2%, and ROE is still deeply negative, reflecting the capital-intensive nature of insurance and the company's stage of development. Liquidity metrics show current and quick ratios just under 1%, and leverage is under 1 times equity, which is manageable but doesn't leave a huge buffer if underwriting turns against them. Analyst sentiment is mixed, with consensus price targets clustering in the mid to high teens, near or modestly above the current share price. The bull story is that Oscar can leverage its tech platform, data, and member experience to underwrite better, manage costs, and scale profitably as membership grows. The bear story is that health insurance is brutally competitive and heavily regulated, and a few bad underwriting decisions or policy changes can wipe out years of progress. The stock has already had a huge run off its lows, so even after a recent 20+% pullback over 3 months, multi-year returns remain very strong. That means a lot of optimism is already priced in. Technically, OSCR trades in the mid-teens after a sharp multi-week slide, including a recent 5+% down day. The chart shows high volatility with big gaps around earnings and guidance, not a smooth trending pattern. Key support sits in the low teens where the last major breakout started, and resistance is in the high teens to around 20%, where many targets cluster. Given this behavior, I view the chart as a series of swings rather than a clean trend. Perfect for nimble traders, dangerous for oversized positions. Oscar is a speculative turnaround in my playbook. I'd want to see consistent profitability and cleaner underwriting trends before sizing it as a core long. As a trade, I'd look for reversals off key support or strong post-earnings trends with tight risk management given the volatility. You probably already noticed that I am specifically targeting 6-month and 1-year long positions. June shows promise when looking at $25 and $30 calls. When looking at January, $30 and $35 calls might be ideal. Lastly, UiPath is a leading enterprise automation platform that started with robotic process automation and is now moving deep into AI and agentic workflows. It gives exposure to the broader AI and automation theme, but with a more enterprise software flavor. In its recent quarter, UiPath reported revenue around $411 million versus about $392 million expected, and EPS of 0.16 versus a 0.14 consensus, beating on both top and bottom line. Net margin has turned positive in the mid-teens, and ROE has moved into positive territory, signaling that the company is exiting its most cash burn-heavy phase. Trailing EPS around 0.42 implies a PE ratio in the mid-30s at a price near $15, with a market cap just under $8 billion. For a company with mid-teens to high-teens revenue growth and improving profitability, that valuation is not cheap, but not extreme relative to high-growth software peers. Business trends and AI angle UiPath is leaning hard into agentic AI, autonomous digital workers that can not only execute tasks, but also make decisions and adapt in real time. They're building tools like Maestro, Agent Builder, and Autopilot, and integrating with major AI ecosystems such as OpenAI, Google, Azure, and NVIDIA to create smarter multimodal workflows. Analyst and industry reports highlight several trends, vertical-specific agents, pre-built workflows that cut customization time by 30 to 50%, and domain-trained models that can boost accuracy by 20 to 35%. If adoption continues, UiPath could deepen its moat with data and integrations across many enterprises. Risks and insider behavior. The risks: competition from big platforms like Microsoft and other automation and low-code vendors, plus macro sensitivity in IT budgets. There has also been notable insider selling over recent months, including sales by top executives, which can be a sentiment overhang. Wall Street generally rates Path as a hold with price targets in the mid-teens to high teens, modest upside from current levels, but not a screaming bargain. Technically, Path trades around $14 to $15, slightly below its 50-day moving average near 15.7 and above its 200-day near 13.4, putting it in a short-term consolidation inside a longer-term recovering trend. Over the last couple of years, the stock fell sharply in 2024, rebounded in 2025, and is slightly down year to date, showing that sentiment remains fragile. Support sits around the low teens and recent swing lows, while resistance is in the mid-teens where price targets cluster and where the stock has stalled multiple times. Some technical models flag more bullish than bearish indicators overall, but it's far from a runaway uptrend. UiPath is on my list as an AI-enabled software name where fundamentals are improving, but the chart still needs to prove itself. I'd look to buy near support with a multi-quarter view if I like the AI roadmap, or trade breakouts above the mid-teens if volume confirms. A breakdown below the 200-day or a string of missed quarters would be my signal to exit. When considering options trades, make sure you get time on this name. Personally, I am looking into January 2027, both the $30 and $35 calls. All right, that's a wrap on this week's market watch list. We just covered 6 names across growth, value, and transition themes, plus the macro backdrop that's setting up opportunities. Here's what I want you to take away from this breakdown. First, the market is maturing. That means strength is selective, not broad. Focus your capital where the trend is actually happening, in small and mid caps, in materials, in energy, in emerging markets, not everywhere at once. Second, get specific with your entries. Don't chase extended moves. Wait for key support levels, pullbacks to moving averages, or confirm the breakouts with volume. That's where your risk to reward ratio actually makes sense. And third, stay nimble. We're in a volatility year. The 6 names on this watch list can swing hard. Have your stops marked, know your profit targets, and don't be afraid to take profits when the setup plays out. If any of these tickers resonated with you, or if you've got your own setups brewing, drop them in the comments below. I read every single comment and I love the discussion. It helps me refine these breakdowns for next week. And please, if this analysis added value to your week, hit that like button and subscribe so you don't miss the next edition. We're dropping these watch list deep dives every week, plus daily market updates in the Discord community. Speaking of Discord, if you're not already a member of the group, the link is in the description, or scan the QR code. That's where we're actively trading these setups, sharing live charts, and building a community of traders and investors serious about finding our place in the market. This week, we've got a significant earnings calendar, the Fed decision Wednesday afternoon, and a potential energy breakout continuation to capitalize on. I'll be in the Discord keeping you posted on all of it, so join us there. Thanks for watching. I'm excited to see how these setups play out, and I'll see you in the next one.